Okay, good afternoon, everyone. It's end of the month again, and welcome to our monthly market updates for Busy People series. I'm Chye, a financial market analyst and coach at Beyond Insight, and this is your express session to get up to date with the stock market. Since we are doing this over the lunchtime, hence we will keep it to 20 minutes. We'll cover the market highlights, major stock market indices performance, and the upcoming potential opportunities and risks out there. So are you ready? You may type me in the chat. Are you guys ready? All right, let's go. Let me start my timer. Just an important note before we proceed, whatever we share here today is based on the latest data and also facts. If there is further development, things may change. And we want to make sure that you know we are not a licensed investment advisor and we do not manage customers' fund. We are an educational institution, so our purpose here is to educate people so that you can make your own decisions and be your own investment manager. All information we share here are meant for educational purposes only and must not be taken as recommendation to buy or sell. Let's start with the market highlights for the month. So how many of you were active in the stock market over the past month? You may type me in the chat. How many of you were active in the stock market over the past month of August? So what do you think about the market? Is it good or bad, or is it for you? What is your opinion on the market? Okay, short-term, yes, short-term downtrend. Okay, so the Nasdaq 100 that represent the top 100 tech stocks in the United States, and also S&P 500 that represent the overall stock market for the United States are pulling back 5 to 8% from the high of the year. So usually when I say pullback, it's a market drop of around 5 to 10%, and it's very short term. And if let's say the market drop beyond that, let's say drop to 10 to 20%, then it will be in the correction phase and can last a few months. And anyone of you know, if let's say drop beyond the 10 to 20%, what mode is that? If let's say the stock market drop beyond 20%. Okay, if drop beyond 20%, it will be in the bear market like last year, 2022. However, there are few fundamental reasons that unlikely. It could be just a temporary pullback. Later, I will share more points about it. And second point will be the inflation. Inflation has been trending down recently, but in the US, it has been rebounded over the past month, where from 3.0% rebounded to 3.2%. And for the United Kingdom and also the European region, they are still at the high level, still at the elevated level, despite they are trending down, where UK has 6.8% inflation and the Europe still at 5.3%. And the market recently pulled back due to a few negative factors. Anyone of you aware of what happened recently in the macro perspective or any news you have read about? Anyone of you aware of what happened recently that causes the pullback? You may type in the chat. Okay, the crisis, please ignore the crisis. China's stagflation, okay, very good. Okay, so there are multiple factors that trigger the recent sell-off or pullback. First, we have the US credit ratings. Let me highlight the word. US credit ratings downgrade. Anyone of you aware of what happened for the credit downgrades? Okay, power fixed, okay. So recently, the Fitch, one of the big three rating agency, Fitch downgrade the US credit ratings from AAA to AA+. So to me, a downgrade by a single rating agency is unlikely to significantly impact the country's creditworthiness or reputation. Anyone know why? Just because of one downgrade, it won't impact the country's creditworthiness or reputation over the long term. This is because the US economy data overall are still healthy. The recent jobs data and also their employment data still solid. And the downgrade may cause a short-term volatility. Hence, this news actually caused the initial pullback from the top. And secondly, we have the bank downgrades. So anyone aware of what happened to the bank downgrades? Just quickly type in the chat. Anyone of you aware of the downgrades for the bank? Okay, so for the bank downgrades, it happened because Moody's cut the rating for smaller banks, for those smaller banks in the United States. And this may affect the regional banking sector because we are now at the high interest rate environment. So a prolonged interest rate environment may cause housing market issue. And if let's say there is housing market issue, then more and more people may default their loans, and the bank may get into trouble if let's say they don't have enough cash flow. Other than that, the bank with high bond exposure also might be suffering losses throughout this high interest rate environment. Hence, Moody's actually downgrade the ratings for all these smaller banks of all these regional banks. However, something to take note, the major bank, those bigger banks or global banks like Goldman Sachs, like JP Morgan, all this has recently passed the annual Fed stress test back in June. So I would say this likely to affect smaller bank only, smaller bank that with a high bond exposure. So watch out for that. If let's say you are investing in the stock market, do avoid all these smaller banks, as we are now in a high interest rate environment. And if let's say prolonged high interest rate environment, they may affect the housing market and also affect those smaller banks as well, because those smaller banks, other than loaning out money to the consumer for purchasing house and so on, they also have a exposure in the bond market as well. And the third one will be the latest Fed minutes. So anyone of you aware of what is the latest Fed minutes about? Anyone of you aware of some of the key points from the Fed minutes recently? All right, so the latest Fed minutes actually shown that there are still Fed members seeing an upside for the inflation, and they mentioned that possibly leads to a more rate hikes in the future. So among the Fed's members, they still see a potential upside for the inflation. Hence, there might be possibility of more rate hikes. And lastly will be the China economic crisis. So anyone of you aware of what happened in China recently? Okay, first of all, we have the property crisis, where the Evergrande filed bankruptcy in the United States, one of their property developer, one of their big property developer, and also Country Garden, they are suffering losses and may default their upcoming bills, their debts, may default their debts, upcoming debts. So the property market in China has been slowed down over the years. So this one start to show off, this recent news start to show off that the property market are getting slower and slower. And besides that, China also have other problems, for example, high unemployment rate, where they have the record high of youth unemployment at 21.3%, and they also have a 5.3% unemployment rate. And recently, the government also announced that going forward, they're not going to publish this unemployment data anymore. They will just track based on for their statistic purpose, but they won't publish it anymore. And next one will be the low consumer demand. As some of you typed in the chat just now, they have the deflationary data, where they have the negative consumer price index, also known as the CPI. So this shows that they are very slow consumer demand in China as well, where people are tightening their belt and not spending money to the retail market, not spending into unnecessary stuff in China. And with all these factors, foreign funds also moving out from China. All these foreign fund actually moving out from China as well, moving out either from the stock market. At the same time, also their factories are moving out from China. So in summary, the US stock market currently in a pullback mode, and tech stocks are pulling back as well. The tech stocks are pulling back as well. However, in our view, it might be a good opportunity once the price reaches a good valuation level. Likely will recover after the September's FOMC, when we have better outlook for the Fed policy. However, we must also watch out for the China economic crisis, because this may affect those stocks that have high exposure in China. On top of that, why I said a good opportunity is, where do you think the funds pull out from China likely will go? Usually, funds will need to stay invested. So where do you think the funds possibly will go if let's say they are moving out from China? Anyone would like to guess? You may answer me in the chat. Okay, Southeast Asia, and potentially also United States, because the US economy is still healthy or still solid among all these different regions. Okay, while the US stock market are pulling back, you can see that the worldwide stocks market also pulling back from the chart here. And despite the US stock market currently pulling back, it does not mean that we can buy immediately. Currently, it's still pulling back, and potentially it may go further down. While waiting for the right setup, investor can identify potential companies to invest in or trade in, or you can also do the valuation and also planning, and also patiently wait for the setup based on our criteria. Also, we want the most consistent market or asset when we invest. So to do that, we need to gauge how their past performance looks like among different markets. So I have prepared the stock market performance chart for the comparison. So first of all, we compare the Nasdaq 100, the S&P 500, the China market, Hang Seng Index, and also the Bursa KLCI. So from here, we can see that the Nasdaq and S&P 500, the Nasdaq 100 that represent the top 100 tech stocks in the US, and also the S&P 500 that represent the overall stock market are pulling back. But the bigger long-term trend is still up. And China market currently still in a downtrend. And over the 10 years, you can see that their performance is lower than the US. And also is still currently in a downtrend affected by the China economic crisis and also funds outflow. And from the chart here, you can see that Hang Seng Index also affected by the overall China economic crisis because a lot of China company actually listed in the Hong Kong stock market exchange as well. You can see that Hong Kong actually underperformed all the market here that I show here, all the 5 market here I shown here. And lastly will be the FBM KLCI, the FTSE Bursa KLCI. Malaysian market actually recovered post-elections and they also shown some sign of funds inflow. But they also at the same time pull back together with the US stock and also the global market. But one thing to take note for Malaysian market is with the current strong US dollars, it may not favorable for Malaysian market. So from here, we can see that the US market is more predictable and provide a more consistent return over long time. So does anyone know why? Why the US market are more predictable and also provide a more consistent return? You may quickly type in the chat. Yeah, this is because they have more well-run and profitable companies, and it's more regulated as well. So in the US stock market, it's not so easy or not easy to manipulate. So they are more regulated as well because they have more regulation to control all this. And other than that, what company that is well-run in the US that you know of? You may type in the comment or the chat box. What company that is well-run that you know of that are listed in the US? Yeah, Apple, Microsoft, Nvidia, recent hot stock, Nvidia, and Meta, and so on. We have a lot of great stocks to invest in if let's say you are in the US market. Hence, I would say the pullback might be temporary. And once we have more clarity on all the macro factors, it may recover again and back into an uptrend for the US market. And also, like I said earlier, if the funds move out from China, and certain funds may need to stay invested in their portfolio. So they will likely to go to US as well because which country has the best economy now? Which country has the best economy now? You may answer me in the chat. Yeah, US, because their employment data still healthy, their jobs data still healthy, and overall their economy still in a healthy GDP growth based on the latest data. And on top of that, there are still money on the sidelines. So we know that from the news, I think a few months back, from the news, we know that there are still 5.3 trillion in cash on the sidelines, parked in the money market. A money market means a fixed income asset that the funds temporarily parking their money, and it works almost like our FD. It's a money market fund. And one of the reasons investors are currently in cash position is to take advantage of the high interest rate returns because the US now at 5.5% interest rate. So if you just park the FD there, you get 5.5% returns through the money market funds in the US. And this massive amount of cash likely to act as a fuel for the next bull market rallies and may also deploy to either the stock market and also or the bond market. So we may need to watch out this huge amount of money in the sideline. So this is like what I mentioned earlier, part of the reason why investors are stocking up on the cash is to take advantage of the risk-free rate. And this could be the next fuel to the next bull market. But they may deploy to the stock market or they may go to the bond market. And comes to the most important part is what to focus on second half of 2023. So first, let's take a look on the opportunities. So we want to focus on industries that align with key themes. So for example, the mega trends. So any one of you know that what are the big mega trends or what are the hottest topic for this year? The key themes for tech stock. Any one of you aware of what are the key themes for tech stock this year? Yes, AI, artificial intelligence. So we want to focus those stocks that in line with all these mega trends, for example, AI, or like for example, 5G, or for example, cloud computing. So we want to focus on those tech stocks that in these industries. And other than that, we also have a PC and smartphone demand recovery. However, this one could be delayed because of slowdown in China, consumer spending are slowing down. So it may delay from, like, let's say 2024 to late 2024. So any one of you would like to share what are the usual upgrade cycles? What are the usual upgrade cycles for your laptops and also smartphones? What are the usual upgrade cycles? You may answer me in the chat section, in the chat box. Yeah, 3 to 5 years. So these are the usual cycle, 3 to 5 years to upgrade our hardware, like for example, laptops or smartphones. And we also want to focus on company with low debt, low exposure to bonds, and with strong cash flow. Because of currently we are at high interest rate environment, we want to avoid companies with huge debt or high debt level. So this company tends to do well. Those companies with strong cash flow, low debt, low exposure to bonds tends to do well during high interest rate environment. We also want to focus on companies with less vulnerable to tightening of consumer spending. So we can see that China slowed down, and also in the US, people are also foreseeing might be some mild recession or slowing down in the 2024 year of 2024. So you can see that people are cutting their expenses, especially on the discretionary expenses. So do avoid those companies that are selling consumer discretionary stuff. Best to focus on companies that are less vulnerable to this. So for example, tech company, technology nowadays is essential or discretionary? You may type in the chat. Is technology now an essential or still discretionary item for you? All right, you may answer me in the chat. I will take a look later on. Yes, it's essential now. Okay, and lastly, for the opportunities will be the money on the sidelines, where we, like I mentioned earlier, we have 5 trillion cash on the sidelines and potentially will come into the stock market or bonds when the rate hike cycle is over. So other than the opportunities, let's take a look on the risk in the second half of 2023. So if let's say the high interest rate prolong, even the Fed do not hike, further increase the interest rate, they just maintain the current interest rate and it's prolonged, it may impact the affordability. So people may find it more difficult to get loan or hold onto a loan because of high interest rate. And also it may cause bond market crisis or bond market risk. And at the same time, also housing market risk. So all these companies that exposed to bond market or those related to housing market may impact if let's say the high interest rate environment prolonged. And next will be the geopolitical tension. We have the Russian-Ukraine war still going on, and also the China-US tech war. And lastly, for the risk will be the slowing consumer spending, where we have the China economic crisis like I covered earlier, and also there is higher risk on discretionary spending side or the discretionary retail side, especially those with high dependency on China or either finance or energy sectors and retail industries. So any one of you know what company listed in the US that having high exposure to China? You may just type in the chat. Any one of you know that companies that with high exposure in China? Yeah, Alibaba, Pinduoduo, all this. So they might be slowed down as well for their earnings if let's say the spending in China slow down. Okay, however, with all these opportunities and also risks, and we can see that currently the stock market are pulling back. In fact, the pullback, I would say, is a good time to capitalize on the opportunities because we can see that the US economic data still strong, jobs data still healthy, and technologies nowadays are essential. And we can see that if let's say funds are moving out from China, they may enter the US market as well. So do take this opportunity, do this pullback opportunities to learn and enter when the stock market, when the pullback are at the right valuation and setup. And with that, you may need to have a systematic and safe way to do that if let's say you want to capitalize on the pullback. So you may need to equip yourself with a systematic, versatile, and also safe way to do so. You need to plan some time for yourself to practice and also pick up the skill set while waiting for the opportunities to happen and get yourself ready when the opportunities come. And also the stock market is still the best instrument to generate high returns than the inflation itself. And the US stock market still has the most consistent return over the years. And since this is just a 20 minutes update and I already overrun the time, we would like to invite you to a free 3-hour webinar that covers a framework on how to approach the stock market in a systematic, versatile, and also a safe way. Also for this coming intake, we have a hybrid class where you can attend either face-to-face or online. So do join us in the 3-hour webinar to find out more. And the next available webinar would be at September 2nd, this coming Saturday, 9:30 a.m. You may scan the QR code to register. And since I have finished my presentation, I will now open up for the Q&A slot where you can either type your question in the chat or you may just put up your hand and a monitor will unmute you to talk to me. Okay, so I see one question in the chat. How long will tech stock pullback? So obviously, myself or a lot of traders, or usually the traders, we as a human, we may not know the future. However, you may need to monitor. We have a method that monitor the stock price chart and monitor for the right setup or right support level or wait for the trend reversal to enter. So yeah, likely for now to anticipate is likely will recover or have more clearer direction after the September FOMC. So this is what we can monitor. We monitor a certain technical level in the stock chart and also wait potentially based on the macro factors and so on. Potentially we will see a clearer picture after the Fed meetings in September. And I see a second question. What is your view on US pharma stocks? So okay, so for pharma stocks or all these biotech stocks, they are much more hard to predict because they are more subject to all these regulation, all these FDA regulations. So if let's say we are talking about US pharma stocks or biotech stocks, I would say unless you are from the medical industry or you are a doctor or what, you are familiar with all these medical industries or biotech industries, else I would say avoid to invest in them because they are more subject to all these FDA regulatory approval and so on. And the stock will be more volatile and more choppy to trade or even invest. So they are harder to predict compared to all these tech stocks and other sectors. So I can see, okay, so China relaxed taxes, how will impact the market? Okay, so currently China actually they have more serious trouble, this inflationary, high unemployment, property crisis, and so on. So even though relaxed taxes, it may just have very small impact to the stock market because they may need a bigger fiscal policy. A fiscal policy means a policy by the government directly to the economy. So they may need to have a bigger fiscal policy. So the recent tax, the taxes relaxed and so on will help the stock market or help the economy a bit, but it's not significant yet because they have more complicated or long-term problem to solve. Okay, so okay, I will take one more last question. So let me pick one. Okay, so historically, August and not a good month. Okay, so historically, yes, based on statistics, August and September will be a more bearish month. That's why there's the one old saying called September dip. So a lot of investors actually taking these opportunities to enter for the year-end rally. However, do watch out for the chart and enter at the right level. And also usually the September dip will happen if let's say we have a huge rally from early of the year, which you can observe for this year stock market. You can see that early of the year it has been a strong rally. So it's quite common the funds start to take profit when there are some uncertainty. However, don't get too panicked or hung up with that because after the pullback, funds may come in once the valuation are right. And if let's say the funds coming back in, we may have a year-end rally towards December. Okay, so I think with that, we have enough questions. I think I handled more than 3. Initially, I said just want to handle 3. So I think let's conclude the market update for today. So thank you for joining us, and I will see you again during the next month market update. So with that, thank you, trade well and goodbye. And if let's say you're interested to join our upcoming webinar, do remember to scan the QR code to register. Thank you. I'll stop sharing now. Okay, thank you and bye-bye.